The Singapore stock market consists of about 1,000 stocks, and it is easy to think that picking the right stocks is just a matter of luck. And because of this, the whole notion of investing seems like gambling. But the truth is, there is a thin line of difference between investing and gambling. Gambling is based on pure luck, chance, and your ability to change your cards into an ace. A research showed that the number of stocks that outperform the market is just only about 43%. That means 57% of the time, you will be picking the wrong stocks. With such low odds, how do you expect to pick the right stocks? Let alone picking the winning stock over and over again for the next 20 to 30 years. How is Warren Buffett able to do it? Is he a god? Nah, he's just a god of gambler. The difference between gambling and investing is that investing is based on your ability to predict the future. Unfortunately, no one has a crystal ball. Otherwise, I would have all in on Tesla stock last year. So let's start. I'm Kelvin, and today I'll be giving you a few simple rules on how you can consistently predict the company's future and pick the best dividend stocks. Rule number 1. If you want to pick dividend stocks, you have to pick companies that pay dividends. That's obvious, right? The easiest way to find dividend stocks is to find companies that have a positive dividend payout amount, also known as the yield. So, how much yield should you aim for? The average inflation rate is about 2 to 3% annually, assuming that the price of your stock doesn't change. If you want your stock to beat inflation, then the stock must have a yield of at least 2%. So why not just go for a stock that gives you the highest yield and call it a day? The reason is that sometimes high yield dividend stocks might be a yield trap. What is a yield trap? Let's say for example, stock A is $1 and it pays out a yield of about 6%. But for whatever reason, the stock underperformed and its price dropped to 50 cents. Now the yield becomes 12%. What it means is that if you bought into this stock hoping to get a large amount of dividend annually, but then the company couldn't maintain its profitability, causing first the stock price to drop, then the dividend payout amount to drop, then that will become a yield trap because you're now stuck in this stock. A good indicator is to always check the company's competitors. For example, the mall REITs in Singapore. Fraser Centrepoint has a yield of about 4.61%. CapitaLand Mall has a yield of about 4.75%. And Suntec REITs has a yield of about 5.25%. Then, you suddenly see Lippo Malls having yield of about 8.55%. Nani? Why is it so high? A simple Google search will reveal that the owner of the Lippo Mall is involved in a scandal. So for me personally, I always look for companies that has a yield of between 2 to 7%, not too low, not too high. Then most of the time, it is able to filter out most of the bad companies. Rule number 2 for choosing the best dividend stocks. Always tap the like button to help out with the channel and look for profitability in the company. You will always want to buy stocks of a company that is profitable. It is such common sense, but most people do not follow this rule. The company's profitability is important because it will determine how long the company can last and how much dividend the company can pay out. No company has ever gone bankrupt by being profitable. As long as you buy into a company that can earn money, you can be sure that the company will be around for a few more years. There are a few simple reasons why profitability is important. First, ability to expand. With more cash, the company will be able to open more business locations, target other markets, increase marketing efforts, and hire even more employees. And all this will in turn generate even more cash for the company. Second, by being profitable, the company will be able to borrow even more money. Banks and investors are more willing to lend money to a company that is profitable because the lenders are smart, because they know that a profitable company will be able to leverage on the money to grow their business. Just think about it. When you were in college, how often did a bank call you to offer you loans and credit cards? Never. Ever since I have a job, banks and even alongs often contact me to offer me personal loans. Stop calling me. How do you get my number anyway? A good criteria to check whether a company is profitable or not is to look at its net profit margin. where it is net income divided by revenue. When the income comes in, after all the bank interest, taxes, operating costs, what amount of the income is left? The higher it is, the more profitable it is. Personally, I like to look for companies that have a net profit margin of at least 10%. The third rule, always look at the company's debt. Debt is important to any company. But then you may say, isn't debt bad? If I borrow $500,000 with 5% interest, at the end of the period, I will have to return $500,000 back to the bank together with $25,000 worth of interest. That's why I prefer to buy my house in cash, said no one ever. There's a very simple explanation for this. Let's say the company is able to generate 20% return on every $1,000. Then the company goes ahead and borrow an additional $1,000 with a 5% interest. 20% return minus 5% of the interest. The company is still able to generate a 15% additional return. That's the power of leverage. The company is able to leverage on the bank's money to generate an even higher return. That, when used properly, is very powerful. It can speed up the rate of growth. Suddenly, you have more money to hire more people, buy more equipment, and increase your marketing efforts. On the flip side, too much debt may be risky. When the company is good, it is able to generate more revenue and it can pay back the debt. However, when the economy is bad, the revenue drops and the company may face problems paying back the debt. And when the company is unable to pay back the debt to the creditors, they may face bankruptcy. So always look at the debt to equity ratio. If it is low, then the company still has more room to borrow more money to grow its business. But if the debt to equity ratio is too high, then the company may face risks of being unable to pay back their debts. Personally, I try to look for companies that have a debt to equity ratio of less than 80%. The fourth tip, price of the stock. As any auntie going to the market may tell you, buying fish at the correct price is important. For example, Mermaid Maritime is about 11 cents, while Berkshire Hathaway, Warren Buffett's company, is about $340,000 to buy.
It's over 9,000!
It's easy to say that Mermaid Maritime is cheap, while Berkshire Hathaway is expensive. But as many people will say, you get what you paid for. If something is cheap, then there is some reason that it is cheap. Instead of just looking at the price, we could look at the price to earnings ratio instead. It will be able to determine whether a stock price is cheap or expensive. The price to earning ratio is, for every $1 that the company earns, how much does it cost to own the stock? If a PE ratio is high, normally it just means that investors are willing to buy this stock even though it is expensive because they expect a higher return in the future. Same for the other side. If a stock price is cheap, that just means that investors have low confidence in this stock and they do not expect a high return from this stock. Take for example, I can buy a Bata shoe with just $30, or I can buy a Nike Air Jordan 14 Retro Supreme with $600. Does it mean that the Nike Air Jordan 14 Retro Supreme is expensive? Yes. Does it let you fly without wings? Yes. Does it look way cooler than a Bata shoe? Absolutely. The PE ratio may vary from industry to industry. For example, the tech industry PE ratio is around 20, while the textile industry is around 8. So when comparing the PE ratio, it is important that you compare the PE ratio of another company in the same industry. However, the price to earning ratio has some limitations because you cannot gauge a company's future earnings based on its current earnings. But PE ratio may help you filter out companies that are excessively overvalued or has its price hyped up too much. The average PE ratio for the S&P companies is around 15. So I will just follow it more or less. I will just use 20 for the PE ratio to filter out any companies that are overvalued. The fifth rule, always look for a company that has a growth potential. Look for a company that has the ability to grow and that constantly innovates themselves. For example, Nokia at its peak in 2007 has a market share of 49%. But in 2007, Steve Jobs walked onto the stage, pulled out an iPhone, and thus started the decline of Nokia phone. Undeniably, Nokia made great phones over the years. But what went wrong for them? The main reason is that they were complacent with their success and they didn't innovate themselves constantly. A great example of a company that has the ability to grow and has a vision is Tesla. Every year, Elon Musk will come up with new products. First, the Model 3, then the Cybertruck, a truck with a very weird shape. Then, last year, they announced a new and better Tesla battery and the Tesla App Store. So if you want to invest in a winning stock that you can hold for a very long time, you must be able to see growth in this company and confidently say that this company will still be around 50 or 60 years later. Ideally, the dividend stocks that you buy should be able to last you a lifetime or even your descendants' lifetime. That is because the longer a company is around, the more a company can grow. For example, if Google is still around 50 years later, you can be very sure that Google has grown so much more and the current price of Google stock right now will be considered very cheap. On the other hand, Snapchat, will it still be around after 50 years? I'm not sure, but if it doesn't innovate himself, then I can be sure that it won't be around anymore. That's a very good quote by Warren Buffett. If you are not comfortable holding a stock for 10 years, you shouldn't own it for even 10 minutes. Look for a stock that's not just complacent with its own success. It must have a vision, ability to grow, and constantly innovate itself. And by doing so, the company will be able to increase its profitability, increase its dividends, and in turn make you a millionaire. Ability to pay dividends, profitability, debt, price, and ability to grow. You now have all the tools to filter out the best dividend stocks. So that's it for this video. Let me know down in the comments below what you think about these rules or any other rules that you may have to filter out the best dividend stocks. Like, share and subscribe as I'll be posting more videos in the future. See ya!